Hello everybody, welcome to the TraderMerlin Show. It is your Wednesday edition, the Knockdown Drag Out edition. I am George Foreman. My guest coming up a little bit is going to be Joe Frazier, because we know what happened in that fight. It will be a duke 'em out sort of thing, but before I get to Justin, I want to real quickly go through why we decided to go into this topic today, talking about annuities. I have a pretty crazy visual here I want everyone to listen to or pay attention to, and that's just some hard facts about Americans and savings. I apologize to my international viewers. This is not representing your country, but I'm sure it's relatively similar unless you're a socialist country. 1 in 4 Americans have absolutely nothing saved for retirement. I'm going to repeat that because it's just ridiculous. 1 in 4, that's 25%, have zero saved for retirement. 1 in 4 boomers, they have less than $5,000 saved for retirement. And 1 in 5 Americans say they don't know how much money they have saved. Here's the problem with saving in America and retirements, is we are told to keep putting money into 401k, put money into an IRA, keep on building and building and building. But to what? Just get as much as you can? That doesn't help you get to retirement. It's annoying hearing someone say, oh, I've got $70,000 saved or $500,000 saved. That's not the answer. The answer isn't how much you have saved. The answer is, how much do you need each month or each year to support you through retirement? If you're one of those boomers that says you have less than $5,000 saved, you're not going to make it through your first 6 months of retirement. So there are products out there, which steers us towards this annuity discussion today, that can help you lock in fixed rates of income. And certainly there's different types of annuities, but that's why we wanted to do the show today, because there are ways we can achieve whatever that number is. And we called it the Annuities Throwdown or knockout venue here with Justin Krebs and myself. So that said, we've got Justin on the line today. Justin, how you doing, my friend?
Good, my man.
Ready to knock him out? Ding, ding, ding. I need the bell to ring over here. It's funny, I couldn't find my Rocky Balboa onesie, but I think if it came down to a regular ring fight, guys, I'm pretty sure Justin would probably beat me. I think he's got a bit of a weight advantage. Justin, I know that you're getting into the space of investment advice and going through a lot of different vehicles to help people through what I was just saying, the fact that most are ill-prepared for retirement. So you are a proponent of annuities. I'm on the fence. I just hear a bunch of crap about them, how bad they are, how riddled with fees they are, and how people should run from them. And I know that that's probably not totally true. I know there's unscrupulous people out there that will sell you anything. But why annuities, and why are we going to have this fight today?
Well, I mean, to put it bluntly, I think they are probably one of the best, if not the best, retirement tool that you can have in your portfolio. I think they should be part of your portfolio. I don't think everything should be in the portfolio, but I think they should. They are. I think an absolute tool to have in there. And I agree. They have such a bad rap. And I have my suspicions. I don't want to say about the industry, but I definitely have my suspicions about why that is. But I think they're an absolute necessary tool. Undoubtedly, not just by my opinion, but by the actual numbers and statistics and facts about them, they'll lend the case. I hated them 3-4 years ago. I did. I was on the same boat as you. I'm like, they suck. They have high fees. That you could do the same thing with a bond ladder, all that kind of stuff. I now know better. So
yeah, it's not that I hate them. Let me be clear. It's not that I hate them. I think with everything, it's kind of like looking at an exchange traded fund. Guys, there are ETFs out there, and most people will tout ETFs and say, hey, they are a great investment vehicle. And I would argue for the most part they are, because it offers diversification. But there are some ETFs that when you look behind the scenes at the fee structures, I saw one at a 15% fee. Like, what? 15%? I mean, that obviously is the outlier. And I think that the discussion of annuities today, there are certainly outliers. And it may not just be the annuity itself. It's the salespeople generally are the bad point here, because they're just out to get a buck. I work with Justin long enough to know that his primary concern is the individual themselves, whether he's teaching a physical class at Online Trading Academy or doing his own thing. It's out there saying, what can I do to help this person do better? And there's a certain altruism there that I think Justin and I both enjoy when you help someone achieve their goals. Let's start off with the basics of annuities. I know we've got 3 basic groupings of fixed, indexed, and variable. So let's start off with whichever one you like. We'll kind of run through the gamut of them and show what their utility is, maybe some of the pros and cons.
Okay. Well, let's start with fixed, because fixed, I think, is probably the most when people think of an annuity, that's typically what they think of. A fixed annuity, flat out, is basically gives you an investment in which you give a premium to the investment company or the insurance company. They give you a guaranteed rate for a year or X number of years, and it works almost identically to basically a CD. It almost identically to a CD. You get your interest in a fixed annuity. It can grow, compounded. But basically by the end of that term, 1 year, 5 years, 7, 10, whatever, you basically can take your money and run, or you annuitize it longer term.
All right, so first one we got there is the fix, and yeah, that is obviously the most simple. I'm sorry, I'm looking at myself. You got your set percentage. Now, I wanted to make a note here because you said they're kind of like a CD. They are, but remember, guys, you're not going to be finding a fixed annuity paying you 20%, right? It's going to be a good number, but it'll probably beat a CD. But again, there's a trade-off there, right? You are going to be paying, you'll be paying commissions, you're going to be paying some administration fees, et cetera, for it, but generally those rates are higher. What do the rates range from for fixed annuities?
Well, right now, because I just actually had a client that, enrolled in one today. 5 years, a guaranteed fixed annuity is paying out 3.35% over the next 5 years, where a CD is like, 1, maybe 1.5, something of that nature. And that's where you said that about the fees. Actually, the fees on fixed annuities are exceptionally low. Right. Basically, you don't actually pay a fee up front. You pay the fee in terms of like a surrender fee. Right. In other words, if you say, hey, I'm locking this up for 5 years, and year 3, you're like, I want all my money back. Well, yeah, the insurance company has paid out administrative fees, commissions, all that kind of stuff. So they're not going to give you, there's going to be a surrender charge. And that ranges usually anywhere, for the most part, most good annuities. This is where you got to watch the unscrupulous salespeople. But anywhere, it starts at about 10 usually, and it diminishes every year for that life of that annuity. Right. So on a 5-year annuity, it might start at, say, 9, and then go to, say, 8, or then 6, then 4, right, then 2. You know what I mean? Yeah.
I think the important part with if you're going fixed is, the overall thing I think everyone's going to get from today is you have to know the terms. Make sure that you question every line item. Make sure everything is crystal clear to you, that nothing is unclear. When you look at the term of your annuity, and Justin just mentioned, let's say it's a 5-year, if you know that you're going to be making a big purchase of maybe a new home in 3 years, then don't lock into a 5-year annuity, right, with that capital if you're going to need it. I think what will happen is a lot of us get enticed because you go, well, maybe if I do a 5-year, I'll get 3.25. But if I do a 10-year, I'll get 3.5, and that extra quarter percentage point, you're like, okay, well, that's great. I get more money. Yeah, but now you're locking up for more time, and you may need that money. So surrender charges can be brutal. Just be sure you know what it is going in, and don't oversign on those contracts. Make sure if you want it for 5 years, then do it for that or less.
Yeah, exactly. The first question out of my mouth when somebody says I want a guaranteed rate of return for the next X years is that, hey, is this money that you don't want to touch or don't need to touch? Because hey, if you do need to touch it, fully pull it out. You might pay. And again, the surrender fees, by the way, are very similar to, say, if you put money into a 401k and took it out early. You get that 10% surrender charge.
And a CD, right? And a
CD, exactly. Same thing.
All right, so the easiest one here is the fixed annuity. Again, that's going to get you a set rate of return. The only problem with that, guys, is it's not, when you hear the fixed rate of return, you're thinking, man, if I could just lock in 8%. And this is one thing when you look at the strategic investor course that we teach on Trading Academy, part of the goal there is to establish what exactly is the rate of return that you need, right? It's not about, hey, I have $5 million and I retire. That may last you forever or it may last you a month. I don't know. So we have to do like a budgeting, personal budgeting, and figure out how much you need during retirement. And if it gets to the point that you say, I need my money to grow at, 3.5% rate of return, and you can just lock in this annuity and get that 3.5 guaranteed, then this is a great vehicle for you because you've locked in and helping achieve exactly the number that you need for your retirement goals or investment goals. So fixed are great because you have that factual known number, but remember, it's not going to be 10, 12, 15, 20% fixed. You could probably find some insurance company that will sell you a 10%, but the fees are going to be crazy because of the risk.
Yeah, exactly.
All right, so let's go to the second one. So fixed is the most basic, generally no fees because it's not, very, very low fees. and most of it's going to be on a surrender charge because it's just basic, right? There's no real management there. What about, what do you want to go to next? Indexed or variable?
Let's do the variable one.
Okay.
Now, because I think the variable ones, when somebody says about, hey, these have very high fees, they're almost always talking about variable annuities. Yeah. So variable annuities is actually a security. It's not a fixed income asset like a fixed annuity. It is literally a security. This is where the insurance company, in this case, will take that money and they actually invest it into funds or, a basket of securities out there. And since it's managed just very much like a mutual fund or any other kind of fund, it has a lot higher fees. I mean, on average, on a variable annuity, you are paying 4% on average easily on those variable annuities. Mm-hmm. So that's one of the big cons. The other big con is that since it is actually invested in actual equities and securities, if the market goes down, you can lose cash value. You are susceptible to losing your entire cash value potentially. Now, on the other hand, what variable annuities will do is that they will have guarantees. They'll have minimum death benefit guarantees, minimum income guarantees, which is one of the pros, right? Mm-hmm. Even if the market does go down or shifts or doesn't perform like it was expected to, these variable annuities will offer you basically minimum guarantees and offer ways to customize it so you make sure that you can pull an income from it or have a death benefit if you die. Mm-hmm. And then obviously, biggest pro of a variable annuity is that it really doesn't have a limit to it. Market goes up, if the fund goes up, you're making money commensurate with what the market does. Mm-hmm. So honestly, the variable annuities, I don't recommend a lot of them just because I do believe firmly that it is for the type of investor that they want some protection, some guarantees, but ultimately they just do want to, have a little bit more of that aggressive style in their insurance product, in their annuity.
Yeah, Big Eb says, in my opinion, they can be a bit of a backstop for non-educated investors to get some gains versus cash, and they can. I agree. I think that's a great point. For most people, like a variable annuity is almost like having, from my perspective, like a manager for you, right? It's a basket. You just put money in. But I look at it, and I agree with Justin. I wouldn't recommend variables either. I think that there are specific scenarios where it would be beneficial, but for most people, probably not. You are getting all the market gains, which is great. But if that's the case, why not just buy the market? Go buy SPY and call it a day. Save yourself 4%. The other part of the red flag, and this is why variable annuities get a real bad rap, is they're variable. Duh, it's in the name. But you can do so many different things. So you have this basic product that you can keep adding on pieces to, and I want more death benefit here, and I want it paid out to here. And those little riders, those little extensions, all are going to have an extra fee. So when Justin's talking about, your 4%, you could be paying more than that because of all the add-ons. And that's a lot where the bad rap has come from, is they will sneak on extra fees there. So, make sure that when you're out there dealing with anybody selling a annuity product, that you trust them. I mean, I couldn't be more emphatic about that one, because I've seen, for most people I've talked to that worked in the industry, they will say the same thing, that there are some absolute shysters out there that will sell their own mother just to make an extra buck, and you got to be careful out there.
Yeah, I totally agree. That is what's nice about the variables, that they are variable and that you can customize. I call a rider, basically, I explain it as it's a customization, right? You can customize it. And that is a big benefit. I do agree that you could just buy the market and you have basically the same types of risk, except in the variable, if you do get the riders, which are obviously costing you fees, they do have guarantees to them. And that's what is nice about those. You can guarantee, like I said, you can guarantee income for life. You can guarantee a death benefit. You can guarantee, hey, if I get sick and hurt, my income doubles for the next 5 years. Stuff of that nature. Or you can actually pay for riders that get rid of the surrender charges in certain instances. It's very, very. This is the problem, and people think there's like a simple. Sometimes I had a client on the phone yesterday, and he's like, "Why are you asking me all these questions?" I'm like, "Because I have to, right? Mm-hmm. If I don't ask these questions and know exactly what you want, I may put you into some position that you don't want, right? And we might as well recognize that right now rather than down the road. And you're like, oh, this is not what I want.
Right. Well, the last thing you want to, especially as someone who's in the business with these products, is have your customer going like, hey, I wasn't informed about that. Why am I in this? And that's the challenge with the variables is, we all have different financial situations. I mean, you got kids. I don't have kids. I got a German Shepherd. I mean, my needs are going to be a little bit different. So obviously, clarity and disclosure is going to be key for you if you're going to look at any of these products. Now, we're both probably in agreement that we'll shift away from the variable. Let's talk about index annuities, the third major grouping. I know there's other subsets, but those are kind of the three we want to focus on.
Yeah, probably in my book, for 90% of the people that we interact with on a day-to-day basis, Merlin, it's an essential tool, an absolutely essential tool, I think, for your retirement. Now, granted, I'll fully admit, I'm a trader. You've known me for 13 years now. If we can time, me and you, we can time the market, right?
Yep.
But me and you get it wrong. Do we get it wrong every once in a while?
Oh, I get it wrong all the time. Yeah, no problem.
Yeah, exactly. You know what I mean? So this is what I really like about a fixed index annuity. A fixed index annuity basically has, I call it the best of both worlds. It has ultimately complete protection, right? You're insured, right? That money that you put into your annuity, it can grow. Everything, all the principal, all the interest, all the gains that you have within that annuity is completely protected, regardless of what the market does. If the market falls flat on its face, it is 100% insured and protected by the insurance company. But here's the cool thing about fixed index annuities. They also participate, much like a variable annuity, they participate if the market goes up. So, but the difference is that the money is not actually invested into the stock market. So there's no risk of you losing your cash value. There's only the opportunity to make money if the market goes higher. Mm-hmm. So the reason why I kind of really get into this with folks is that, number one, fixed index annuities they can provide a lifetime income for you, period. And they do it by pulling money. See, me and you, we can set aside money, and we could invest in a bond ladder. We can invest in the stock market, ETFs, etc. But we ultimately have 100% risk, no matter really what happens, right? But what we can't do is we can't create what are called mortality credits. See, the insurance company can pay you more than me and you can make, because they pull all this money from all these other folks, right? Mm-hmm. And they're very smart. They got these actuaries, and they say, hey, most people only live to, say, age 85. Well, all these people buy these annuities, and there's billions of dollars in these annuities. And what happens is some of those annuities, right, some people aren't going to live very long. So they don't have to pay out the income. They don't have to pay as much income to those people. And then there's people that live beyond 85, right? That's where they pick up. The longer you live, you're picking up what are called those mortality credits. Mm-hmm. And we can't do that by ourselves, but the insurance company can do that.
You talked about the bond ladder, which, and I think when I mentioned at the beginning, and I think Big Eb hit on this one as well, there's a subset of group of people that you and I, we thrive on doing it ourselves. We love the game. We love the challenge. We love the strategy. I mean, it's like, I love backgammon. It's a simple game. Not a chess fan, but I like backgammon. But I could play that game 100 games in a row and still feel happy about the 101st game. And to me, that's what trading is for me. There's other people who, may have won the lotto or inherited, $10 million and going, I could care less. I just want to see a rate of return achieved. Now, those people are not going to be the ones that are out there every day, trying to play Tesla and Apple stock. They probably shouldn't. Once they can determine their number, this is where something like that index annuity comes in handy, and they can just plop it in there and say, okay, I'm going to get a set rate of return. Now, you mentioned something, and I want to make sure I get it right. With the index annuity, you were saying that there's downside protection. So is that a subset of it? I know that there's some that are like locked to an index annuity where it'll be against the S&P 500, for example. And let's say the S&P goes up 20%. The index annuity will only maybe be ceiling down at like 10% gains, but no losses whatsoever. Is that a different type of index annuity, or?
No, exactly. So the index annuities, as their name implies, they're indexed. So they will be indexed or basically mimicking whatever index is within the annuity. And most annuities, fixed index annuities, will offer multiple different indexes that you can invest in, mm-hmm. which is nice. So you got a little bit of diversification there. But what happens is, you're right, if the index goes up, well, the annuity will have something called a participation rate. So let's say, for example, your annuity has an 80% participation rate, meaning that, if the S&P goes up, the index goes up 10%, your annuity's interest will be credited 8%, right? So And in essence, that's what you're giving up a little bit of that, some of that gain for that protection. Because if the S&P drops 10%, all your money is protected, all your principal, your interest, all that is insured. And if you really think about it, how does that perform over the long term? Well, basically, if you had just take the last 20 years. I mean, we go 10%, 10%, 10%, 10%, 10%, 10%, down 50.
Yeah.
Right. 10%, 10%, 10%, 10%, down 50. So what's happened is people are gaining, and they're gaining all this money, but then they're giving half of it back. So they spend the next 3, 4, 5 years recovering their losses. Well, how about this? How about you have a product that goes up, 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 maybe not as much as that 10%, maybe like 80% or 90% or 70%, but it goes up, it goes up, it goes up. And then when that market crashes, boom, it stops, it resets, right? And then let's say, so you have that crash, you're not losing anything, you're just maintaining what you have. And then of course, what happens when you start to recover? 10% or 8%, 8%, 8%. And I'm telling you, I've ran so many different Monte Carlo situations. I even read some research, Monte Carlo situations in which if an investor takes stocks and fixed index annuities, that is the best combination of you personally can have as a retiree. Fixed index annuities outperform bonds. They take less money than bonds. I mean, think about it. If I told you, hey, you know what? I can protect your capital. I can do it with less money, right? I can guarantee you an income. I can customize it. I can make it tax deferred. You don't have to worry about the market going any direction. I mean, what are you saying? You know what I mean? What would the average investor do? It's a common sense decision,
Well, I mean, I would look at it akin to what I'm trying to do myself, which is I'm trying to participate in these market gains as they happen. I'm not always going to get the full 10% unless I'm just buying the index, because I'm doing a bit more market timing. Obviously, I'm trying to beat whatever that 10% number you're throwing out there is. But the downside protection is a thing that usually destroys most people. And anybody nearing retirement, well, right now it's okay, but if you went back into February, you probably soiled your pants a little bit watching your retirement account drop 40% in a couple of months. The key is obviously lock in that downside, make sure that you don't lose it. I'm not going to say I have 0% years. There's years where I have negative, right? And it's unfortunate, but sometimes it happens. What's nice about that index is no losses. And it's one of those things that, for me, I'm looking at it from the perspective of, we've had a market that's been in one of the most voracious bull markets we've ever seen. Now, it could still continue up. I'm leaning more into the camp that you're going to see this S&P at 4,000 here in no time, because there's blue skies and nothing above it, and crazy earnings and support from the government and Fed. Great. An index annuity might be great in giving me, letting me get, let's say, 80% of each annual's move. But if this thing comes falling apart, I mean, there were people back in February that look in their index annuity probably just wanting to go run in and kiss their brokers, right? I mean, did you get some love in February? No,
that's off limits in my practice. So.
Nice. What else do I need to know about annuities? Because I'm not going to say I'm a skeptic. I certainly don't like the variables. That just seems to be the better. I actually would put myself more in the fixed, because I like knowing I can get a fixed amount, although it's not usually a high number.
Yeah.
Index is probably where I would go. What are some of the red flags or things you want to address with regards to annuities?
Well, I mean, on the fixed index side, one of the other things I'd like to point out too is that you actually have access to capital. Most fixed index annuities will permit you, not like a fixed annuity, but a fixed index annuity will have a certain withdrawal percentage. So most fixed index annuities will allow you to withdraw 10% for free each year. So in other words, you have $100,000 into an annuity, that can still grow, earn you interest, all that kind of stuff. But if you say, hey, my 16-year-old daughter needs $10,000 for a down payment on a car she's purchasing, you can take that out without penalty inside of those fixed index annuities. So these things are always offering that custom, and that's not a fee-based anything. There's no payment for that. There's no riders for that. That's just typically what these fixed index annuities do. So what I think is that, basically, since notice there are so many moving parts in these annuities, just have somebody that knows the industry that you trust to actually say, hey, here's the pros, here's the cons, here's the strings attached, and here's what you ought to know for your particular situation. Sure. And it's going to be different for everybody. Yeah. I mean, like you're saying, you need to have somebody that you trust to be able to kind of do that.
Step number one for me, everybody, is, again, finding out not just how much money you have. That's obviously good to know. But when you look at some of the calculators that are out there, to figure out exactly what your budget is, right? Like how much are you spending every month? And I told you guys, I actually tried to do a video for Online Trading Academy a while back, and the compliance department said we cannot do it on this topic because my title was going to be How to Get Rich. Because essentially, that's, to me, how you get rich, is managing your income, your expenses, your liabilities, and you manage that to a positive number, and then you take that positive number left over every month, and you build it by, is it an annuity for you? Fine, that's great. Is it just going straight to the stock market? Great. Is it putting all your money on Tesla? Probably not. But there's these things that we can do to grow our wealth and get wealthy and get rich. But we got to know what that number is. So if you haven't done it yet, I would highly encourage you guys, make it your plan this weekend to sit down and say, how much do I need a month? If I were to retire today, what would be my nut that I need every month to make it through retirement? And once you have that number, it's great, because if you tell yourself, okay, I need $4,000 a month, right? That includes paying my mortgage, and who knows, maybe your house is paid off, but all your expenses, if you say you need $4,000, then you can now start crafting those pieces. And it might just be you've got 75% of your money in the equity and bond markets, and you take 25% and 20%, throw it in annuities to lock in a fixed number, and then keep that 5% of your cryptocurrency account if you're Brendan out there. But the biggest challenge is most people just don't know what that number is. So I don't particularly care whether you guys, what asset class it is. You got to start with that number and work from there. What did you say would probably be the biggest challenge you see when people come in, Justin, that are saying, hey, I'm interested in annuities? Are most people following that same category as I'm describing? They just don't know what they need?
Yeah, actually, most of the folks that contact me, though, they actually kind of know what they need. And, because right now, a lot of the folks that are coming to me are actively researching annuities. So sure. When they do, they kind of are trying to educate themselves. But yeah, I mean, I think number one, that's where we started. You're exactly right, Merlin. We start with, okay, how's your income? Do we have a guaranteed? There was a book out there. It was called Paychecks and Playchecks, written by Tom Henga. I love it. It's a really good read. Some of the information's outdated at this point, but it's a really good read. And he says, look, in retirement, you have to guarantee yourself that you have your paychecks, yep. Right? So that income gap, what's your expenses? What do you have coming in, Social Security? What do you have coming in on pensions, all that kind of stuff? And if you find that you are, say, $1,000 short per month, well, why don't you just say, hey, okay, what's an annuity going to pay me? So go out and find a good income annuity, because there's two different types of fixed index annuities: income annuities and growth annuities, or accumulation annuities. So the first place I start is, okay, you need $1,000 a month. Okay, what's the minimum amount that I can invest to get $1,000 a month for the rest of my life? And we take that number and we put it into an income annuity. And then the other thing is, all right, well, now we have extra money. So now we have an annuity that's going to guarantee our income. Now, what do you want to do, right? Do you want to travel? Do you want to, leave more money to the grandkids? In that case, then you have your portfolio that has, maybe some stocks, maybe a growth annuity in it, maybe some, REITs, real estate investments, stuff of that nature. And if you can just lock in your paycheck, lock in your retirement income, and then you can invest how you want with the rest of your money.
Right. Yep. But I don't need to do that, Justin, because I have Social Security. Social Security's gonna bail me out, man. I don't need any of this stuff.
Yeah, which we all know the issues with Social Security right now. I mean, it's underfunded. I think I've seen different dates, but I think by 2035 it's going to be completely, Yeah.
It's funny. In all the years I've done this, so I've worked with financial planners years ago, and you notice now a lot of spreadsheets have it built in where you just say, add in Social Security or not. So you can just check this button and take Social Security out of the equation. I would encourage you guys to do that, because just remove Social Security, because then if you do get it, it's just icing on the cake. But plan for not having Social Security, guys. I think it's one of the biggest Ponzi schemes we have in the United States.
Oh, yeah. I have folks literally that I talk to that their entire retirement income is Social Security.
Oh, my gosh.
And
that's scary.
It is really scary. And I mean, and the first place that I go is like, look, we need to probably have a little bit more of a guarantee just in case. I mean, those people probably, though, at this point are fine, because they're already retired. They're already taking in the Social Security. But folks that are coming up that are 45, 50, 55, that's where you're kind of getting that spot where may be in trouble on the Social Security side.
Yeah, absolutely. Let's see. Okunola asks, are there variable indexed annuities? So I think he's looking for a hybrid between the indexed annuity and to me, that's what the index annuity is, or variable annuity is, right?
Yeah, I mean the variable annuities, they'll have 30 to 100 sub accounts that you can, and sub accounts, I mean funds that you can invest in. Choose from, yeah. But the money is in the equities. It is in those funds, so it's susceptible to losing. Absolutely.
Okunola, that's a great question. This is, again, one of the things that when you look at the agencies that are reviewing some of the unscrupulous brokers out there selling it, a lot of times one of the biggest complaints is, I was put in the wrong investments, right? And so when you're looking at that variable annuity, as Justin says, there's many different things to choose from. Make sure that it fits your risk profile. If he's like, oh yeah, we're going to throw you in the 100% metal mining category, but it's going to be higher fee, but boy, you could be making 60% a year. If it sounds too good to be true, it probably is. So don't sign right away. Be careful. Do your research on it. But if you're thinking tied to the S&P 500, sure, that's easy. Go for it. Now, remember, with the index, you've got the lock to the downside. With the variable, you don't. And we've got a market that's up tremendously right now. So my gut would say go with the index, just so you have that floor in there.
Well, you can pay for
a rider.
A rider that will limit you. Yes.
Nice.
Yeah, but still, you can't do anything about the cash value going down. You can guarantee a floor in case you die, or in case you want to take income. But yeah, your cash could be gone.
Tom says, what rate would I make with the most aggressive annuity? He says ballpark number range would be great. So you mentioned with the fixed at a little over 3. What's like the most aggressive one you could think of?
Well, if we're talking about a fixed index annuity, right now a guaranteed income annuity is going to pay out. I mean, a lot of them are paying between 5 and 9% on the income base. So that basically just means that their cash value may stay still. It may not be growing because the market may be dropping. But on the income base, the money that they can pull from for income for life, it will grow at a guaranteed 5 to 9%. And that could improve if the market goes up beyond that and all that kind of stuff. On the long-term growth accumulation side, most of these really good accumulation annuities, they have been averaging annualized, and some of them go back 10, 20, 30 years, annualized returns of about 6 to 9% annualized rate of return. And think about that. If I could guarantee you a 7% annualized rate of return and have absolutely no risk to the downside, I think the majority of people, out there and with their retirement money, they should take that all day long and twice on Sundays,
Yeah. Well, but Justin, if I could look at the market right now, I could be making 10% a month. I mean, come on.
Sure. If you got the skill, the education, the time to do it, I'm all for that. You know what I mean? We teach education.
I know. I'm just being a smart ass over here because, a lot of, that's what's funny is I saw some great memes out there that says, hedge fund managers, getting 5% rate of return this year, while Robinhood investors are getting 2,000% rate of return. It's like, yeah, everyone's lucky every now and again. What other questions I have here? Ulysses says, how do you invest in annuities? You would talk to an insurance agent. It's an insurance product. That's what Justin is doing. Is there a way to build a synthetic index annuity in a portfolio? Yes. It's a lot of work, though. I mean, we talked about bond ladders with Bill Addis a while back, and bond ladders are one way to do that, guys. If you're like Justin and myself who loves to be in the game, then a bond ladder is probably the way to go because you can build it. Of course, it's tactical. It's not as clear cut as, hey, I'm just going to buy this or this. There's a lot of decision-making process that goes into which type of bond ladder am I going to do. Am I going to do barbell or ladder? Which products am I going to buy? How much risk am I going to be taking? How often do I roll it? So there's factors there, and you have to be religious about it and put it on a calendar and make sure you make those moves all the time. That's the synthetic would be do it that way. That's why annuities are out there, is because there's a huge amount of people who just don't want to take the time or have the knowledge to build a synthetic bond ladder.
Yeah, I mean, and I agree with you there. You can do it, but again, my counter to that is simple. You can create bond ladders. It takes a lot more time. It takes a lot more effort. You have to be on it. You have to be managing it. And here's the thing. It takes a lot more money. Let me give you a statistic. If you wanted to pay yourself $100,000 every year for the rest of your life, the average retiree would have to have $2.5 million to create a bond ladder, to consistently create those bond ladders to get a guaranteed $100,000 a year on average. Whereas if you just put $1.9 million into a fixed index annuity, that guarantees you 100,000, and there's no maintenance, there's no nothing on it.
Yeah.
So it takes a lot more money to get the same result, and a lot more time and a lot more effort and skill to be able to do that. So yeah, I mean, you can.
Yeah, it's just a lot of work. Let's see. Adam says, "Hey Merlin, there's often a saying, time in the market beats timing the market. On what basis do I support this?" Do you want to go with that one first, Justin, or you want me to?
Man, well, that tears at both sides of me right now. Because, yeah, I mean, look, if you're good at market timing and you know what you're doing, dude, I mean, you can make a lot more return. I mean, there aren't people out there that's, you know, like the Warren Buffett, like the Paul Tudor Jones, one of my favorite, Linda Bradford. Well, I guess it's just Linda Raschke now, but
she's
yeah, but I mean, they're amazing. And yes, I mean, they've been in the markets for 20, 30 years, and they have well outperformed by far the market.
Yeah.
If you have the skill level. If you don't have the skill level, then I mean, yeah, you know, then maybe you should take more of the guarantees that other products offer them.
Yeah, let me share just for Adam out there. I look, if you don't want to spend the time and effort to do it, then it's probably best just to buy and hold. But I do think there's an advantage to market timing, and I'll just show you one quick example that should make it abundantly clear. I'm showing you the monthly right now of the SPY, and I'm going all the way back into, let's call it, where are we at? I'm at 2000. So if you were a buy and hold investor, notice I've got this little black line on the top here. I'll move it around so you guys can see it. That was when the SPY was trading at about, let me get that line perfectly, right around 155. Well, had you been using specific market timing tools and just got out of your positions as this thing started to collapse, you're not saying you would have picked the top, but you would have avoided this 50+% down move. So here's one area where a market timer would have not lost 50% of the portfolio. Maybe they would lose 10% or 15 or 20, but that's 30% extra that your long-term buy and hold person lost. But you're like, it's okay. It came back. And you're right, it did. Let's look. It came back up, hit that number, and for like 1 week, your portfolio would have been positive again. 1 week, and that took all the way until October 31st of 2007. So you're looking at 7 years.
Hold on. It's positive nominally, but you've lost value in real dollars because of inflation.
Correct. Yes, you add in inflation and you're losing. But it gets even worse. If I was to just zoom out and keep trying to show you guys the same example, it took all the way until March of 2013 for that same money, if you did nothing with it, that was at that peak in 2000, all the way to 2013. That's 13 years that you guys are out there saying buy and hold, buy and hold. Your money did nothing, and as Justin points out, if you adjust for inflation, you're losing money. But these moves are not small. I mean, this was a 50% drop, right? You look at that move from 2003 or 2002 to 2007. I'm not saying you're going to catch that 104% rally, but you might catch 60% of that. And if I avoided 40% of that sell-off, my portfolio is going to run circles around the long-term investor. So I definitely think if you have the aptitude and the understanding of market timing, you will beat anybody who's a buy and hold investor. If you overdo it and try to time every single blip, you'll probably lose.
I agree wholeheartedly. And here's the thing too, like if you just had if you just had a good understanding of market timing and actually what I call smart dollar cost averaging. I hate dollar cost averaging, but smart dollar cost. So in other words, if you're saying I'm going to invest $1,000 in the market every month, well, why don't you be smart about it? And when certain markets in your portfolio are up like they are now, why don't you reserve only $200 to invest in the market, reserve the other $800, and then when the market down, flip the script and then put more of that money into it when it's at the bottom. So if you can do a dollar cost averaging the smart way with some market timing, again, your portfolio has just crushed 90% of what's out there.
Yep. You know, and going to the comment that was brought, or message here from Andrew. Andrew says, over the long term, markets generally go up. Not generally. Markets do go up over time. It's an architectural design thing. They are built to go up. So, you know, when you look at what's happening right now, you have Raytheon, right? Raytheon being removed from the Dow Jones Industrial Average here soon, ExxonMobil and Pfizer. These are names that we all know. I mean, these are American icons. Something changed. They're getting removed. It's like the star quarterback. It's like Tom Brady going to play for Tampa Bay. He's no longer a Patriot. Is he still the best quarterback of all time? I don't know. If he was, he'd still be in New England. Sorry for the Tampa Bay fans out there. But so you're gonna remove those companies, and you can put in Amgen, Honeywell, and what else? Salesforce, CRM. So it's just swapping out the bad underperforming stocks with these really new darling growth potentials. That's why markets go up over time. They are architecturally designed to go up. So that is a true fact. Over time they do. But you know what? When we look at this chart right here, and Justin's in the financial planning space, you look at a market that looks like this. 2009 SPY, my friends, was trading at a low of $67. It's at 347. Any financial planner in the world would tell you it's a pretty overextended picture right now. If they don't tell you this is overextended, I don't think they're doing their job.
Oh, I talk to people every day that still are convinced that they have other advisors or something that and guess what they're telling them? Yeah, they're telling them it's still continuing to probably go higher.
Yeah,
they're seeing it. They're seeing it continue to go up.
Yep,
it's ridiculous.
Absolutely. All right, Justin. Well, so if people want to know more, I think I had your website up here. Let me bring it back up for the viewers. It's theproactiveinvestor.com, correct?
That is correct. Yeah, it's I'm shifting the website over right now. So next week it's going to be an awesome website. But yeah, you can check it out this week. It's the temp website's up right now. But yeah.
Nice. And so you got to schedule a meeting. Ooh, do you guys get to schedule? I got to schedule my meeting today. You get to schedule one with Justin anytime you like.
Yeah.
Any parting thoughts? I don't know if there's a victor in this one. I think the most important thing is it's an understanding of how this investment works. I'm not saying I'm anti. Certainly, there's certain annuities I am anti. There's other ones I think are great vehicles. Any parting words for our viewers?
No, I mean I do think they're absolutely key part of your portfolio, your overall portfolio. I mean, if you can lock in guarantees and participate when the market goes up, and if I have $400,000 in the market and I can lock in $100,000 guaranteed, that will make me money over the next 10, 20 years, guaranteed income, and I can invest the other $300,000 in other vehicles. I mean, that's a smart tool. It's a tool. You use a tool to get your project, to get your goal, right?
Yep.
It's a tool.
Yep, absolutely. Well, Justin, thank you so much. I appreciate it. You got back-to-back weeks with Justin. Hopefully in the near future we'll get you back on again. I don't know what our next topic's going to be. I'll go get my boxing gloves because maybe we can't do a virtual boxing match. I don't know. There you go. He's got them all set.
I also know a guy that's a little bit of a spitfire. His name's Dwight Traderman. He's been itching to get on your show.
Isn't he a floor trader from Chicago? I think he's always passed. Oh, no, he was a order taker. Yeah. All right, cool, my friend. Well, thank you so much for coming on today. I appreciate it. Look forward to having you back on again soon. You know what? Hold on real quick. Last question came through. Canola says, is there a minimum to enroll? I don't know if it's not enrollment, but I'm assuming that these are going to have some minimums. But it's not like you can come in with $10 because the insurance company's going to be like, you're wasting my time.
I mean, the smallest that I've seen is like a couple grand. But yeah, it's a couple grand, about 10 grand is usually the minimum to invest in an annuity. Yep.
Nice. All right, everybody, that will do it for Justin. Thank you so much. I appreciate you coming on today, my friend. Take care.
See you, bud. Thanks for having me on.
My pleasure. All right, the Rumble in the Jungle. I don't know if anybody went down on that one. I'm hoping you guys learned a little bit about annuities. They should be scary and daunting when you go in and talk to your investment advisor. That's generally what they want, right? The more that you don't know about an instrument, the more likely they can tack on a ton of fees. So for those of you considering annuities, obviously Justin is in the business. You can go to proactiveinvestor.com. If you're using another broker, that's fine as well. Just make sure when you go in there, do not let them push you around. Make sure you ask a ton of questions. Don't let any line item on there. I want to know, ask them things about, okay, what's the commissions fee structure here for you? What are you getting paid on this one? What about the riders? I want to see any percentage fee I'm being charged. What about management fees? What are the surrender charges? What's the duration of the contract? What are the investments I'm being put in? It sounds daunting, but if you don't pay attention to those numbers, you can absolutely get hosed with regards to being in bad investments and locking up your capital for too long. And I'll tell you, if you just pull up annuities online and just talk about bad rap or red flags, there's a ton of them. The SEC has done a lot over the years to try to help curtail some of the shenanigans that go on. But a lot of it is just what Justin was pointing out. That's why I love Justin. He's transparent. He's not trying to gouge you with fees. He's trying to get you in the right thing. And when you look at a lot of the rider details, especially with the variable annuities, that's normally where the shenanigans happen. That's normally where they get people with all the big fees. Gary says, can you post the link to JK. It's let's see. I think it's I think I can. The Proactive Investor.com. I think that is it right there. All right, let me real quickly look at a couple things. We talked about the swaps out in the Dow today. I thought that was kind of interesting. You had 3 companies being removed, 3 companies being added and announced to being added. And of course, that creates some major waves in those stocks. So let's look at the ones that were being added. Oh, my dog is having a nightmare. If you hear some really weird sound, guys, it's not me. It's my dog. I promise you. So ExxonMobil is being taken out. XOM. Just out of curiosity, if ExxonMobil is being removed from the Dow, what can you expect? Like, there's a logical thing you should expect here. And that is going to be this. A good amount of selling going on in ExxonMobil. That said, let me tell you, I'm pretty sure that this was... people have known about these additions. It's not like they just randomly woke up this morning and said, hey, let's take these 3 out and add these 3. There has been a thought process, an evaluation, and making sure... yes, the proactive investor makes a big difference. There's a big... I forgot what's going with that topic. But anyway, when you have these companies being removed, it doesn't just happen in a snap of fingers. It takes a while. Now, if you look at what's happening with ExxonMobil right now, it looks to me like this has been known for a little while. It was down today. The reason it's going to continue to sell off is it's being unloaded by every mutual fund that tracks the Dow. Every single one of them is tracking it. So that to me is important for anybody trading on these instruments. ExxonMobil will probably continue down. That's being removed out. Amgen. Here's Amgen. Actually, Amgen had a little bit of update, surprisingly, today. God, I've never traded Honeywell. Honeywell is the other one. Let me see real quick. I can never remember the ticker. Somewhere. I think it's HON, right? Is it HON? Yeah, so Honeywell was up a little bit. It's hard to not have an update when the market was as up as it was. It was a pretty gorgeous day for the equity markets. I mean, just ripping to all-time highs in what we call blue sky, which means there's nothing above us. Those are the ones that were being... when we look at the Dow adjustments, you're looking at Exxon, Pfizer, and Raytheon being removed, right? So these, the ones I just showed you, Amgen, Honeywell, and CRM being added to a little bit of a pop. CRM was really the big one. Here's CRM. It was up 20+% today, just a monster jump. I believe they also, if I'm not mistaken, I think they had earnings on Monday or Tuesday, so that might be also reflected in that. I think maybe they had earnings last night. If you look at Pfizer, PFE, right? So these companies should be headed south. And you saw Pfizer today sell off. You had ExxonMobil, which we just looked at, selling off. And then you had Raytheon, which is RTH, if I'm not mistaken. Raytheon taken off. Look, and no, what's Raytheon? That's not RTH. One sec. Let me pull up Raytheon because I can never remember. It's a lot of Dow stocks I don't trade. Raytheon stock. There we go. RTN. I don't know. I had RTH in there. There you go. So Raytheon should be down. I didn't check it out. RTN, come on. Huh? Not getting the stock price. All right. RTX. There's your Raytheon. Small down, nothing noticeable. But keep an eye on those next few days. They'll probably continue to drift down as those readjustments are made. Okay, let's see. What else do I got today? Hi, Merlin, just checking in. Thoughts on FIS pattern we looked at the other day. Still holding that downtrend, time to jump ship on the short I opened, I think. Let's go to FIS. Why not? Yeah, I'm hoping you already jumped ship and locked in some profit. Thanks, Big Eb. Yeah, I'm a little slow on that one. So, Frankie, that FIS, I think if I remember correctly, it was a couple weeks ago, you were talking about shorting as it came up into this area of supply, right? If I'm not mistaken. These last 2 days have been absolutely brutal for you. Hopefully you put a trail stop in there and locked in some of that profit that you were up on that short. S&P could go parabolic from here. Raj, I'd make the argument it's already going parabolic. I mean, look at that ES. This is accelerating, and then of course, the struggles for the Dow will get tougher as soon as Apple splits. We'll talk about that one in the next week or so. Don't forget Tesla this Friday. I think it's Friday. What is today? I'm losing track. Gosh, I'm having a senior moment out here. Today's the 26th, which means we will see Tesla split on Friday. So for those of you who have shares of Tesla, be excited. I'm pushing for the Tesla to close at $2,100 on Thursday night. That's my goal. I would love it. It'd be hilarious if it closed at $2,100. My guess is you will see institutions pushing this to $2,100 by close. Just because when you do a 5-for-1 split on a $2,100 stock, it will open the next day at $420. And that's just because Elon Musk is a little bit of a stoner. I think it would be appropriate. Very fitting for him. I see. Adam says I see a decent pullback in the next 2 to 3 weeks. You know, Adam, I'm kind of with you. I just feel like it has to. But then anytime I end up try to go short this thing, I get beat up. I mean, I get just slaughtered. Especially shorting the S&P. It's just been brutal. So, you know, I do think we're bound to have a significant pullback, not just in Tesla, but in other companies as well. Normally, and I think I mentioned this before, when you have a stock split, what happens is there's this big surge up in the price of that security because people want to own it when it splits because they feel like they have 4 times as much or 5 times as much. You don't. You have 5 times as many shares of Tesla at 1/5 the price. So it generally rallies up, and then once it splits, it actually will get a lot of people selling and drop that thing down. So I would be inclined. I would almost be thinking about going short here as you get into tomorrow's session on Thursday. All right, let me wrap up the show. I'm already gone way too long here, and unfortunately I got a ton of stuff to do tomorrow. Raj, ask me that tomorrow. I will get into as much of that as I can. I just got to get out of here before 3 o'clock. I got a meeting I got to get to. So let me go to your economic calendar and earnings calendar just so I can show you some of the stuff that happened today and what might be happening for tomorrow. By the way, tomorrow will be a Bitcoin show. So I know some of you are probably not going to join because you hate Bitcoin. I think you might like it. It has to do, I'll talk a bit about the US dollar. I'll talk a bit about Bitcoin and why it's so different than the US dollar and why I think that the digital currency has a place in all our portfolios. I'm hoping I change some of your perspectives on Bitcoin. I know a lot of people think it's just voodoo and smoke and mirrors. I'm not going to get into the architecture of how Bitcoin works as far as private keys, public keys, and the number of combinations, unless you guys ask me. But I will do my best tomorrow to show you why this is a completely different animal than any stock that we'll ever see or currency you'll ever see. So here's what happened today. The reason we saw this big market soar, they were expecting a pullback in durable goods orders. That's kind of the big ticket items, TVs, refrigerators, and things like that. So they were thinking it was going to drop to 4.4% versus 7.6% the previous month. Boom, we jumped to 11.2%. That means there is a lot of spending going on. That's great for the market. And of course, we saw the markets just take off today because of that. Crude oil inventories came out a little bit worse than expected, but no big deal. Here's what we have for tomorrow. A lot of announcements, particularly for the U.S. You have GDP or preliminary GDP. This would represent, I believe, well, they're looking at negative 32%. Of course, remember, that's an annualized GDP number. So I think it's no surprise we'd see a big contraction. It's funny, we see a negative 32.5% GDP annualized, yet markets are all-time highs. Something's not right here. Unemployment claims expected to be right about 1 million. You also have Powell speaking, and of course Powell usually gooses the market to the upside, and pending home sales. That's a surprising number for me. The previous number was 16.6% gain in pending home sales. They're looking at 2.5%. So, yeah, that's a pretty big drop. Anyway, other than that, you got some announcements coming out for the euro as well. Andrew says, is John O'Donnell coming on the show anytime soon? As soon as John can get Skype on his computer, he's welcome anytime he wants, but he won't put Skype on his computer, so I can't have him. That's the only way I can communicate with guests here. I do it via phone. It doesn't work in here, so I got to have him on Skype. So get Skype, J.O. If you guys know John, tell him to get Skype, put it on a computer. I want to get him on the show. He was my regular Friday buddy, man. I loved having John on the program. All right, everybody, that's going to do it for me. That's your calendar for tomorrow. Economic announcements. Tomorrow will be a big Bitcoin thing. I haven't even built out the presentation, so I'll be up to the wee hours of the morning making sure that this thing looks great for you guys tomorrow. Bring your crypto questions. I'll do my best to answer as many of them as I can. I'm going to try to focus predominantly on Bitcoin because to me that is obviously the main one at this point. There are a lot of other projects out there, many of which I don't know that much about, to be honest, but I do know some of the major stuff out there. So hopefully you guys join us tomorrow. If you have any Bitcoin friends, people who are interested in Bitcoin want to know more, title should sell it all. Why Bitcoin will be over $100,000 by 2023. I think that should be pretty appealing given it's $11,000 right now. All right, guys, that's going to do it for me. Thank you so much for joining us. If you liked Justin, check out theproactiveinvestor.com. You can click that thumbs up button, leave us comments and questions down below the video. I will see you mañana talking Bitcoin.